for tonight's module, I call putting it all together. And I'm going to talk about avoiding common mistakes in valuation. And then I'm going to go into one topic in a little bit more detail, specifically valuation versus valuation cap, because I think there is a fair bit of confusion about this, and it's pretty important for you to understand. So I'm going to take some time to explain about that. And then valuation negotiation strategies. So I'll talk about what are the challenges that you may face in negotiating valuation, whichever side you're on. So negotiating valuation as an entrepreneur with a startup, with an investor, or as an investor with a startup, and try to share some insight and tips and tricks about valuation negotiation strategies. So most common valuation mistakes. I'm going to look at most common valuation mistakes from the perspective of the entrepreneur, meaning what are the most common valuation mistakes that I see entrepreneurs making. To set the stage for that, we just want to review: investors want lower valuations, startups want higher valuations. Everybody knows this. We talked about this in previous classes. So investors want lower valuations because the lower the valuation for a given amount of investment, the more equity the investor gets, since the formula for calculating how much equity goes to an investor is investment divided by valuation. So the lower the denominator in that equation, the more equity that goes to the investor. And by the same token, entrepreneurs want higher valuations because for a given amount of investment, the higher the valuation, the less equity they give up. And of course, this extends also to existing shareholders after the first round of funding. So once the startup raises multiple rounds of funding, existing shareholders typically want higher valuations, investors want lower. So that's all well and good. Now, first common valuation mistake. I have encountered startups who do investment pitches, but when I ask them what's their valuation, occasionally startups say they don't know or they don't have a valuation. And I think this is a terrible mistake, because it looks really, first of all, I think it looks really bad. Why does it look bad? It looks bad because it shows that the entrepreneur doesn't know that they're supposed to have a valuation. And this is a very fundamental assumption that investors are going to make, that when an entrepreneur is pitching for investment, they will have arrived at a valuation at which they expect that investment to take place. If you think about it, the entrepreneur is the seller in this situation. The investor is the buyer. So the entrepreneur is selling equity in their company. The investor is buying. So imagine, you walk into a store or you walk into any negotiation and you ask, you're a buyer, you ask the seller, what's the price for what you're selling? And they say, I don't know. We don't have a price. It's ludicrous. So now it can just be the entrepreneur is very new to the game and they didn't know they were supposed to have a valuation, but that means they haven't done very much homework on how this process works. And I think this always raises in the mind, I know it raises in my mind, but I think it raises in the mind of an investor, what else don't they know? If they don't know something this basic, what else don't they know? And another variation of this is, I have entrepreneurs say, the valuation, it's up to you, up to the investor, which that's a little better than I don't know, but it's also, I don't think it's a very effective, I don't think it's an effective approach, and I would I would classify it as a mistake because, again, you walk into the shop, you're the buyer, somebody's selling something, you say, hey, what's the price? And they say, it's up to you. Just give me whatever you want. So, of course, you're going to offer extremely low. Why would you offer anything but the lowest possible price for this? Because you don't want to negotiate against yourself. So I don't think it's smart, and I don't think that it helps the negotiation position. And sometimes I think entrepreneurs might be trying to do something a little more sophisticated here by not naming the valuation, because they do have valuation in mind, but they don't want to name a number that's too low, so they try to get the investor to go first. So that strategy is not wrong, but I don't believe you can execute that strategy by saying you don't have a valuation or know the valuation, or the valuation is up to the investor. If you want to try a strategy like that, then I think the best way to do is you might have a range of valuation. I'm not a big fan of that either. I think you should have a real valuation, but if you really want to play that game, then you could try with a range of valuations. Okay, next mistake. This one is not that common, but I just want to mention it for completeness. Occasionally, I have met entrepreneurs who set their valuation too low. This doesn't happen often, so in a way, it's not a common mistake, but it is a mistake. You definitely don't want to set your valuation too low, because then you give up too much equity. And again, when you set your valuation too low, this sends several bad signals to the investor. One is, why is it so low? Why is the entrepreneur setting the valuation so low? Do they not understand that they should want a higher valuation? Do they not understand what is the market around companies like theirs? What's the market valuations? And they don't know that they're putting themselves either way at the low end or even below the low end of the market. Or is there something wrong, very wrong with this company, and that's why the entrepreneur is trying to do a quick deal at a low valuation? So all of the signals that a too low valuation sends are bad. There's no good signals there. Now, the much more common mistake that I see entrepreneurs in valuation discussions make is asking for a valuation that's too high. And this means they will give up too little equity. So I would say this is the most common case. Most entrepreneurs that I talk to, their initial valuation is too high. When I say too high, let me be more specific about that. Let's assume there's a range of reasonable valuations for your company, the entrepreneur's company. Let's for a minute, let's say that the range of reasonable valuations for this company, this type of company at this stage of development, let's say it's, for example, $2 to $5 million. Let's say that is a market for this company in this sector, in this geography, at this stage of development. So when I say too high, I don't mean the entrepreneur's asking 6 or 7. I don't think that's too high. I think that's perfectly reasonable. The range is 2, in my mind, range is 2 to 5. Entrepreneurs saying 6 or 7. Okay, I can respect that. Why not be a little above the high end of the range? Nothing wrong with that. And I think that is where you want to be, where you should be as an entrepreneur in your initial ask. You should be at or slightly above the high end of the range for your company. There's no point to be, already at the middle or low end of your range, because in most cases you're going to have to negotiate, which means if you're negotiating, the valuation is going to go down. So I think starting at the high end of your range or a bit above the high end of your range is fine. What I mean is range is 2 to 5 and entrepreneur starts the negotiation at 15 million. So in this case, I see the absolute high, I see the high end of the reasonable range is 5 million and entrepreneurs asking for 15 million. And to me, when I hear that, I think it's game over. There's no further negotiation to follow, or very rarely will there be further negotiation to follow. Why? Because my thinking is, how can we possibly get to a mutually acceptable solution if I think high end is 5 and you think reasonable is 15? There's just no way to bridge that gap. Later, I'll talk about one strategy that we might use to get there in some cases. But generally, I feel we're just way too far apart. And again, if you can't relate to this scenario, imagine, let's say that you're shopping for a new house in, let's say you want to buy a condo in Bangkok, and you think reasonable price for the condo that you're visiting is 10 million. And the owner, when you visit, their asking price is 100 million. So you're not even going to bother to negotiate because you see no way to get there. You feel that the seller has highly unrealistic expectations. So you don't want to be, I don't believe that you want to be perceived as a seller as having highly unrealistic expectations. So I think, again, high valuation expectation is fair. You should definitely don't want to give up any equity that you don't need to give up, but it has to be reasonable. One of my favorite examples of this was a startup that I met in Thailand a few years ago. I really, really liked the company. They were doing their seed round. I was really impressed with the pitch. We got to the valuation discussion. I thought fair valuation was around 5 or 6 million US for this company. And when they got to their valuation, they said they're asking 60 million. 60 million. So this is not just a theoretical problem. This is a real life problem. At first I thought I misheard. I said, wait, did you say 16 million, 1-6? And the entrepreneur said, no, 60 million, 60. So needless to say, no deal done. And I still remember that negotiation, or very short negotiation, and feel it's a shame because I think I really like the company, but when you're that far apart in the valuation, there's nothing to talk about. And then the next question that you're going to get when your valuation is way too high, how did you arrive at that valuation? And that's what we spent the last 3 classes learning, how to calculate valuations. And I can guarantee you, when your valuation is, 2, 3, 5, or 10 times the market valuation for your company, then the valuation, the assumptions that you made in your valuation calculation are going to be, wrong or extremely questionable. So you're not going to be able to, again, effectively defend that valuation. And then you're going to send another really bad signal to the entrepreneur is, not only do I have, to the investor, not only do I have unrealistic expectations, but I'm not very good at backing up my numbers with good calculations. Okay, now, but you might wonder, when I say valuation is too high, there's a second problem with asking for too high valuation, which is what? Even, let's say if your valuation is unrealistically high, let's look at what you might consider the best case scenario here. I go in and I ask for really high valuation, and I get it. For whatever reason, the investor was willing to give me a crazy valuation. So maybe, and that does happen sometimes. So you might think, okay, despite my view that this is a bad approach, it might be worth, maybe you feel like it's worth giving it a shot on the off chance that it might happen. Because if your company, instead of being worth $6 million, actually get a valuation $60 million, isn't that great for you? And didn't you just win the lottery? The answer is no, because going in with way too high of a valuation expectation, it's not only bad because you're unlikely to get a deal, it's also bad when you get the deal at too high of a valuation. So how can that be the case? I talked about these already. What are the problems that we experience with asking for too high valuations? So they send a message, they send a lot of bad messages. Entrepreneur doesn't know the market, does know the market, doesn't care, has unrealistic expectations. And once again, as soon as you communicate unrealistic expectations about one thing, and especially something as important to the deal as valuation, this always raises concerns in investors' mind. What other unrealistic expectations does this entrepreneur have, and how are they going to become problems in the future? Negotiations can be over before they even begin. And if the startup does get their wish, gets too high valuation, it is still highly likely to be bad. So this is like the expression, be careful what you wish for because you might get it. So what is the problem with high valuation? Why should that be bad to get too high of a valuation? Because companies don't just raise one round of funding. Companies raise, successful startups typically raise multiple rounds of funding. So when we think about valuation, it's important, of course, to think about the valuation for this round and what does it mean to our shareholders today and how much equity they're going to have to give up when we do this deal. But that's not the only thing that we need to think about. We need to think about what does this valuation mean for future rounds. So I like to say to entrepreneurs, too high valuation is okay until it isn't. And when is it not okay? It becomes not okay when you meet an investor who prices your company properly, or worst case, you meet an acquirer, or at the end of your fundraising process, you go to sell your company and you sell it for a valuation way below what your last round investment valuation was. So as long as you keep meeting investors who are willing to give you unrealistic valuations, you're okay. But this won't happen forever because at some point the company is going to meet an investor or an acquirer who prices the company properly. When that happens, if previous round valuations were too high, all of the shareholders are going to suffer, and typically founder shareholders suffer the most. Why? If the company raises a down round with massive dilution. So what do I mean? Example, let's say that 6 million company raises this round at 60 million, but then next round, if they were 6 million this round, maybe they were supposed to be 12, they would be 12 million in the following round. So after they find somebody to come in at 60 million, then what happens when next round they get repriced back down to 12 million? Because that might be fair for the company at this stage. That means that all of the existing shareholders are going to be terribly diluted because the valuation went down by something like 80%. And this means everybody's going to be diluted massively. And it's highly likely that investors who overvalue the company, assuming they're not totally crazy, they're going to put in place things like anti-dilution protection, which means that when the company reaches a down round, the effects of this massive dilution will not be shared equally among all the shareholders. They will be shared disproportionately by founder shareholders. So anti-dilution formulas shift the effects of excessive dilution, which occurs in down rounds, to particular sets of shareholders. And in the vast majority of cases, that will be the founder shareholders. So this can be a very, we call it Pyrrhic victory. You got that great valuation in the last round, but now you got nothing after your down round. Another problem that can occur with too high of a valuation, if the company was priced too high and then the founder shareholders want to sell the company, maybe they find an acquirer, but the acquirer is not willing to pay a price that gives a reasonable return to the investors who came in at too high of a valuation. So investors may block that sale. And this means the founder shareholders who might have had a very nice payday at this sale now get nothing because their investors block a sale at too low of a price. Another variation on this, the company was too highly valued. Later, it sold at a low price relative to the previous round valuations. Again, investors who are willing to overvalue but are not totally irrational will most likely have liquidation preferences and probably participating liquidation preferences, which can mean that this company that was overvalued in early rounds gets sold at maybe even some decent price, but founder shareholders get nothing because the liquidation preference of the investors who overvalued the company means that they get all the proceeds. And I have seen this happen in real life, so it's not, again, a theoretical concern. So there are many bad potential outcomes from overvaluing your company. And the only way to avoid these is you get overvalued forever until you get to exit, and then you get bought at too high of a price. And this might happen sometimes, but I wouldn't bet on that as my strategy as an entrepreneur, is to hope that I can overvalue my company in every funding round and then get acquired at an overvalued price. I'm a big fan of high risk, but to me, that's a ridiculously high risk strategy. And of course, you don't need to do it. If you just value reasonably, you can avoid all these risks and you can still sell your company and make a lot of money. So what are some other common valuation mistakes? One is over focus on valuation in negotiation. So a lot of entrepreneurs that I've met only negotiate about valuation. It's almost as if the whole deal is valuation. And definitely valuation is important, but it's not everything. Valuation is an important thing, but it's not the only thing. So the risk when you over focus on valuation in negotiation is that you neglect other terms. And there are other terms in the agreement that are of similar importance to valuation in terms of the economic results for the founder shareholders. And I'm thinking of, for example, liquidation preference. So the difference between no liquidation preference and a 1x non-participating liquidation preference and a 2x participating liquidation preference, this can have a much bigger impact on entrepreneurs than a few percentage points of equity in valuation negotiation. And a lot of entrepreneurs will totally miss this because they just focus on valuation. And another related mistake here is missing the relationship between valuation and other deal terms. So when entrepreneurs try to negotiate exclusively on valuation, they miss opportunities to trade things like liquidation preferences, like anti-dilution formula that we talked about before, for improved valuations. And the valuation negotiation I talked about in a previous class, it's basically a zero-sum game. It's a zero-sum game where one side gets every increase in the slice of the pie going to one side makes the other side's slice smaller. And those type of negotiations are very difficult to come out with a good solution from. But if you negotiate the terms more holistically, including valuation along with other economic terms like anti-dilution and liquidation preference, you can start to make this negotiation a non-zero-sum game, and both sides can come out better. Another very common valuation mistake, I've mentioned this in previous classes, but I'll go into a little more detail now, is using outlier for comparable valuation. So comparables valuation, as we talked about in previous classes, comparables valuation is a perfectly reasonable and legitimate way to value your company. But the way that comparables valuate, why does comparable valuation work? Comparables valuation works because it compares your company to a group of companies. It compares your company to a representative group of companies, an average of more than a few companies. And this is what makes comparables valuation meaningful, because you compare your company to an average of multiple companies. To, let's say, an average of an index of companies is ideal if we can construct some sort of index. So let's say average valuation is 5 million. So this means that, does that mean your company has to be 5 million? No, because that's average. But once we have an average, then we can also have for example, average, and then the 25th percentile, and then 75th percentile. And you can argue now that in a very meaningful way that my company should be valued at the, let's say, 75th percentile of this comparable range, or at the top of the comparable range, because we're better than the average company in this comparable basket because of XYZ that we can explain. So this is a very meaningful way to talk about the valuation of your company using comparables. But I've met more than a few entrepreneurs who value the company using comparables method by picking one company and always picking a freakish outlier at the high end of the valuation scale and saying we're identical to this company and therefore our valuation should be the same. And this is wrong in so many ways. It's almost I don't almost have time to list all, but I think you can see right away what's wrong with this. We now have eliminated the most important aspect of comparables, which is that the comparable valuation sets up a range using average valuations for a basket of companies like ours. By just picking one company and saying we should be valued exactly the same as this company because we are the same, and this is a company that has a freakishly high valuation, there's no logic to that, and there's no power in that argument, because by the same token, I can just say, okay, so let's find a freakishly outlined company that has incredibly low valuation, and then that should be your valuation. So there's both of those arguments don't make sense, because they're no longer comparing your company to a basket of comparables. They're just picking one random company, not exactly random, but just picking one company that suits our negotiating positions. And in the way that this is applied, it's even worse than it sounds here, because almost every time I hear this is how it goes. The startup, for example, they're based in Thailand, and they say, and they're seed stage. So let's say, I think reasonable valuation is 3 million US, so 10 million Thai baht. So they found a company, 100 million Thai baht. So they found a company that is, they'll say, there's a company in the US that just like us that raised their seed round also, and they're valued at 30 million US. So, a billion Thai baht. So that's what we should be. That's fair for us. That's the comparable company for us. But obviously, it's not the comparable company for you. Why? First of all, you're not the same because you're in Thailand and they're in US. That's difference one. Difference two is even in the US, they're a freakish outlier. And we know that because we can see the average seed stage valuations for companies in the US, and they're not 30 million. And you know why you know this company? So usually the startup will say, oh, I saw this company, for example, in TechCrunch, which is, you probably know, it's a well-read blog in the US on startup companies. So why do you think that this company's seed round was in the news? Why was it headline news? Because it's a freakish outlier. You don't see articles in TechCrunch every day about startups that raise their seed round at 5 million valuations in the US or 6 million, which are about average, because they're not news. So the companies that are not news are the basket. They are the average. When you pick a company that's already news, that means they're already freakish outlier. That means they're already not a comparable to be used in comparables valuation. So definitely try to avoid that approach. Then next problem is next most common mistake, using what I call using the wrong discount rate for discounted cash flow valuation. And of course, the wrong discount rate, everybody uses too low. They never use too high. So if you attended the discounted cash flow valuation course, I advocate using discount rate that reflects the cost of capital for the equity investors who are investing in seed stage companies like yours. And their cost of capital is not 10 to 20 or 30%. It's much higher than that. I find it's 80 to 120%. And therefore, I believe that you should be reflecting your real cost of capital from these investors in the discount rate for your DCF. And when you do the DCF with a discount rate that is appropriate for publicly traded companies that are much less risky than yours, this is, of course, going to improve your valuation. But then investors who have a different view of the cost of capital for your company have a very easy negotiating strategy, because they can just now negotiate about discount rate, and the discount rate is coming from their cost of capital. And if you, I've done this myself when entrepreneurs come in with DCF calculations with what I consider way too low discount rates, I just ask them to put in what I think is a fair discount rate, and this will reduce their valuation by something like 80 or 90%. And it's very difficult for the entrepreneur now to negotiate around that, because then they have to explain why they need to change. If we're going to agree to use higher discount rate and they still want to get a high valuation, then they have to change other assumptions in their model. And it's very difficult to explain why you need to go back and change other assumptions in your model just because we adjusted the discount rate. The other assumptions in your model, for example, the revenue growth rate should be independent of the discount rate. So I think better if you're going to use DCF valuation, I would go in with a high discount rate and that reflects the valuation that you want. If you have a high discount rate that yields the valuation that you want, then you've got everything covered. So I would definitely avoid low discount rate in your DCF. And one other valuation mistake, confusing pre-money and post-money valuation. So example, when entrepreneurs give a valuation and I ask, is it pre-money or post-money? Sometimes they don't know. Of course, you must know the difference between pre-money and post-money. We talked about this in a previous class. Pre-money is the valuation before the investment, and post-money is the valuation after. So you see this also in convertible notes. When entrepreneurs have convertible notes, they sometimes unaware of or don't even ask investors, or it's not clear whether the discount in the convertible note applies to the pre or post money valuation next round. So whenever you're talking about valuations, make sure that that you are clear and that you clearly understand whether the valuation that's being discussed is a pre-money or post-money valuation. And remember, whenever you're calculating how much equity goes to an investor, the calculation is investment divided by valuation, and the valuation in the denominator of that equation is the post-money valuation. And this is what that looks like with a couple of examples. So pre-money is value before investment. You can see that if with a 3 million pre-money investment and a 1 million investment by the VC, this means the VC gets 25% equity. Pre-money equals post-money minus investment. And then post-money valuation, you can see it's the exact same thing. So 4 million post means 25% equity for the VC. So you can also always remember, if we know any two of these numbers, we know the third one. So if we know pre-money plus and we know investment, then we know post-money. If we know investment and post-money, we know pre-money, etc. Now, this is one other valuation related topic that I wanted to bring up, because I have found there is a fair bit of confusion about this, is valuation versus valuation caps. Valuation is found in priced equity rounds. So meaning the investor invests a certain amount of money at a given valuation, and that determines how much equity the investor gets. This is a real valuation of the company today. Convertible notes and safe notes. So convertible notes are debt, and safe notes are convertible instruments used by startups and VCs that are not debt. Both of these may have what's called valuation caps. Now, these valuation caps determine at what valuation the notes convert. So when we're dealing with convertible notes or safes, the way they work is the investor doesn't get any equity when they invest. So they invest in exchange for a convertible note or a safe note. Typically, convertible notes and safe notes have discounts. And example, 20%. So let's say the investor puts in $1 million in investment and gets a convertible note with a 20% discount to the next round valuation. So if the company raises the next round valuation, raises the next round of investment at a 10 million valuation, and the convertible note has a 20% discount, then the investor, instead of getting 1 million divided by 10%, they would get 1 million divided by 8, because 8 is 20% discount from 10. So that's called a discount in a convertible or safe note. In addition to discounts, some notes will have a discount and a valuation cap. So valuation cap means that the note will convert at the lesser of the discount or the valuation cap. Example, so the investor puts in 1 million, 20% discount, but they have a 5 million valuation cap. So that means that in that next round that I just described, when the note converts in a 10 million round, then instead of converting at 8, which is the 20% discount, this note would convert at 5, because the valuation cap of 5 was lower than the discount. And if the next round valuation happened at 6, then the investor would convert at the discount, because discount would be 80% of 6 would be 4.8, which is less than the valuation cap. So valuation cap sets a cap on what discount this note would convert at, but it's not a valuation. So when entrepreneurs say they have a convertible note or a safe note with a valuation, they're usually wrong. They're usually not talking about a valuation, because the vast majority of these type of notes are not valued. And the reason they're not valued is because typically convertible notes and safe notes are used in situations where it is difficult to agree on a valuation. So one of the major benefits of using convertible notes and safe notes is we don't have to agree on valuation, but we might have valuation caps. So don't confuse valuation cap with valuation, because still valuation would mean that the note would definitely convert at that valuation. With the valuation cap, we don't know that. With the valuation cap, we know that the note might convert at the cap, or it might convert at the discount, whichever is less. Now, important to understand about valuation caps, which from discussion with entrepreneurs, I'm not sure that they do understand this, but in my view, investors should be willing to give valuation caps higher than current valuation. Meaning, example, in the company I just talked about, if I'm an investor who feels that a fair valuation for the company today is 5 million, but I think 10 million is too high, then I should be willing to give a valuation cap between 5 and 10, and maybe even valuation cap at 10. Let's say entrepreneur wants 10 million valuation, I want 5. We talked about before, it might be very difficult to close a deal here, but I might be willing to give a valuation cap at 10. Why is that? Because why don't I want to give a valuation today of 10? Because I think that valuation is way too high for this round, but I could be wrong. And the valuation cap only comes into play in the next round if the valuation of that round is higher than the valuation cap, and specifically if it's more than 20% higher than the valuation cap. So in that case, I would be maybe willing to do 10, because then if the company raises, let's say company's raising at 10 today, this implies that they believe next round valuation should be significantly higher than 10. If they're right, then I'm okay. What do I mean? Let's say I give valuation cap at 10 and next round is at 20. So now I'm happy to convert at 10 in the next round, because it's a huge discount to next round valuation. The startup was right, I was wrong. Actually, 10 would have been fair today if they really raised the next round at 20, but we couldn't agree on that. So that's why don't confuse valuation with valuation cap. And also you can use valuation cap negotiation to get a higher valuation cap than you could a equity priced round equity valuation at this point. Okay, so how to value your company, and this is what we've been learning during the program, but I want to just remind everybody. So first thing to value your company, we need to calculate the exit valuation, because exit valuation is going to be very important for our other valuation methods. I would calculate the exit valuation by doing a 5-year revenue forecast, and then we can multiply our year 5 revenue by sector multiple for assuming we're looking at an M&A trade sale exit, using sector multiples for comparable M&A transactions, but avoiding outliers. Example, if our year 5 revenue is 30 million and the revenue multiple in our sector is 5, this gives us a projected exit valuation of 150 million. At seed stage, we can get a valuation from that 150 million of 2.5 by dividing by 60, or for Series A, we can divide by 30 to get a 5 million valuation. We can cross-check these with comparables methods. So 1 to 3 million for seed stage companies in Southeast Asia is perfectly reasonable. 5 to 10 million for Series A companies in Southeast Asia, perfectly reasonable. So you can see here, we might be able to improve our Series A valuation because we're at the low end of the comparables range. And I would like to cross-check these two by using doing a DCF with a appropriately high discount rate. And a lot of times, or I have heard some entrepreneurs complain, when they value with VC method, they get a different result than with their DCF. And of course, the different result means their DCF gives them a much higher valuation than VC method. And I have had entrepreneurs tell me, this means VC method doesn't work. I don't agree. It doesn't mean that VC method doesn't work, because actually VC method, it's the most direct way of valuing companies for venture capital investment. The reason I think that your DCF calculation gives you a different output, different result than your VC method is because you're not putting the proper discount rate into your DCF, meaning the VC method also effectively has a discount rate. It's discounting the exit valuation by a certain factor. So if you use the same, I believe that if you use the same discount rates in your VC method and your DCF, they're going to give you the same result. And actually, this is the whole way that our model is set up. Our model is set up to give you, to help you to arrive at the valuation, same valuation using different methods, making sure that your assumptions are consistent in each method so that you have a very well supported valuation. Now, does that mean it's right? Can't argue about whether valuation is right or wrong, but it does mean that your valuation is well supported by your analysis. So when I said in the previous slide, we can't say that your valuation is wrong or right based on your calculation, what does it mean? All of the valuation methods that we discussed in this program do not actually determine valuation. So the valuation that comes out of our financial model is not your real valuation. What is your real valuation and how is it determined? Your real valuation is determined by negotiation between you and investors. And that's the real valuation. Valuation is a price. The valuation is the price that you're expecting to get paid to sell your company, or in this case, selling shares of your company. So when you value the company, this puts a price on the whole company, and then we can divide that up into the number of shares, and then we sell shares at that price. Now, if valuation is a price, what determines price? VC methods and discounted cash flow methods and comparable methods don't determine prices. Prices are determined by supply and demand. And the supply and demand in the market in which buyers and sellers transact whatever's being sold at this price. So the actual valuation of your company is determined by the supply and demand of investment capital for your company. And that's the reality. So it's very important to keep that firmly in mind. The real valuation for your company is the valuation that the market is willing to pay, meaning the highest price that some market, a buyer in your market is willing to pay for your equity, that's the real price of your equity. And how does that work? If you think about supply and demand. So if there's only one interested investor in your startup, that means demand is limited and supply is exceeding demand, and therefore valuation is going to be in the investor's favor, meaning the buyer. If there's more than one investor, then it's highly interested investor, then it's highly likely that valuation will be favorable for the startup. Because why? Now the demand for your equity exceeds the supply. There's a fixed supply of equity. You only have 100%, and in an investment round, you're not selling 100%. So let's say, for example, you're selling 20%. So the supply of equity in your company is fixed and limited and fixed. The more demand there is for that 20%, the higher the price is going to be for that 20%. the lower the demand for that 20%, the lower the price is going to be. And the lowest possible demand at which you can still make a sale is one buyer. And a lot of startups end up in that situation. They only have one interested buyer, which means they don't have a lot of leverage in the valuation negotiation. So how do we get more leverage in the valuation negotiation? Get more than one interested buyer. So what are those investors buying? And after the founders' capital, so founders put in their own money, they get their friends and family money. In the first round, generally seed stage, the founders are selling, or the investors are buying the dream. What do I mean? They believe in the entrepreneur, they believe in the vision, they see the market opportunity, they think there's good product market fit here. So they're willing to take a chance on the dream or the vision that this company is going to be a huge success. But in the next round, entrepreneurs are selling and investors are buying traction. So by the time the company moves out of seed stage to next round funding, investors are going to want to see how fast is this company growing and how much did their customers love their product. So you have to be very careful that you don't find yourself in a situation having to sell the dream 2 times. What do I mean? See a lot of startups, they successfully raise a seed round by selling the investors on their dream, but then they don't generate traction with the seed round funding and they have to go out for a second round of selling the dream. It doesn't work. It very rarely works. So it's very important that after you close your seed round, you generate traction. If you can generate a lot of traction with your seed funding, you're going to have an easy time of raising your next round. And then again, same thing. After investors are buying traction, next rounds or in future rounds, they're buying revenue, they're buying profit, they're buying the technology, the market, the product, and the team. So make sure that as you raise multiple rounds of funding for your company, you're shifting use of funds into generating the metrics that investors are really going to buy. Now, I want to talk a little bit now about valuation negotiation. And this is my favorite fundraising pitch. You go into investor and you say, I'm so sorry, but this round is already oversubscribed. And then the investor is going to ask, like, well, oversubscribed means the investor can't put money in anymore. And then they're going to ask, well, why did you bother with this meeting if you don't have any, equity for me to buy? And then you can say, well, we still had some room when we scheduled this meeting, but there's been a lot of interest, very quickly, and its round is full. And then when the investor looks disappointed, you can say, we might still be able to make some room for you if you can move quickly and go with existing terms. So this means, what does it mean? Why is this such an effective pitch? Because now just to be clear, this all needs to be true. Don't try to make this pitch unless this is true, because investors, before they put the money in, they're going to definitely know for sure whether this was true or not. So you can never make this pitch unless it's actually the case. So the way to make this pitch is to get yourself into this situation and then raise money if possible, and then close your round if possible. But why is this so effective? Because what this pitch shows is there's incredible demand for this company. And investors, if you think about investor psychology, I like to say nobody wants to be first. Investors are very hesitant. A lot of investors are hesitant to be first. Why? Because they wonder why they're first. Why are we the first investor in this company? How come somebody else hasn't already expressed interest, or how come nobody else has invested yet? There must be something wrong with this company. That's why nobody's investing. So, so nobody wants to be first, but nobody wants to miss the train as it's pulling out of the station. So once a lot of investors are interested, or even a few investors are interested, this tends to make everybody else interested, because they think, oh, why is everybody so interested in this company? I better not miss out. So this pitch puts you in that situation with the investor. So how do we get the best possible results from our negotiation? get more than one term sheet, get more than one interested investor. Come into negotiations with reasonable, but it can be robust, high valuation, but can reasonably high and robust valuation methods, so that you have you can explain why you have a reasonable but high valuation, and you can do so in a way that is going to satisfy most investors. Think about trading things like liquidation preferences and anti-dilution for higher valuations. Remember, the whole negotiation is not about valuation. Think about the deal as a whole, and make sure that you maximize the economics for you, not just the valuation. And try to remember, I always like to say, best outcome for especially valuation negotiations is both sides are mildly dissatisfied. So the entrepreneur feels like, oh, it's a little low, we could have got more. Investor feels like it's a little high, we could have got less. But nobody feels like they got exactly what they want, because referring back to the zero-sum nature of this negotiation, one side is too happy, then the other side is probably not happy. And we can use convertible notes or safes to bridge large gaps in expectations. So I mentioned earlier an example where we might be able to close something like a 100% expectation gap between a 5 and 10 million valuation with a convertible note, maybe valuation cap at 10, or maybe valuation cap at something like 7.5 or 8. So if you really get stuck on valuation, but both sides still want to do the deal, sometimes convertible notes or safes will do the trick. And just a couple of things that investors say to entrepreneurs that I want to interpret for you. So because I do hear entrepreneurs come out of meetings with investors and with the wrong impression, because let's say that the investor says, we're willing to commit to this deal if you find a lead investor, or we're willing to commit to this deal if you find something like we're willing to commit if you do something. So this means they're not interested. Of course, everybody is willing to commit if you do something, right? If you increase in value by, if your results are great, if you get huge deals, if other investors are interested, we'll be willing to commit. But I would just discount those statements to mean they're not really interested at this point. When investors say, we're really interested, please come back and see us when you have more traction. Again, of course, everybody wants to get a free option. So free option means a lot of investors don't want to say no. They don't want to say, forget it, we're never interested in this deal, because what's the value to them of doing that? If it turns out the company is really successful, they would like to invest. So they'll just say, yeah, come back and see us when you have more traction. Why not? If you never get more traction, you don't come back and see them. If you do have tremendous traction and you come back, then they're probably interested. So nothing wrong with saying that, but I wouldn't overweight that. You know what I mean? Like, when somebody says we're really interested, come back and see us when, that means pretty much zero interest today. They might be interested, if things go great in the future, and now you've already established a relationship, so you can go back and see them. But this is just something investors say, either A, to be nice, or B, to keep open a free option to invest in you if it does turn out that you're successful. I'll go back to the questions. Question 1, what is reasonable discount rate for startups? So for me, I believe that the discount rate for startups should reflect the investor's real required return in that startup, because I think that should be the startup's cost of capital. And for seed stage startup, the investor's required return is 80 to 120%. So when I do DCF valuation for startup, I like to use discount rate at 80 to 120%, somewhere in that range. And I would match it to the VC method. So if your DCF valuation gives you the same result as your VC method, then it means that your discount, then I think that it means your discount rate is correct in your DCF. Okay, second question. How does a startup determine its proper valuation cap when raising a SAFE or convertible note? So I think for valuation cap in SAFE or convertible note, it's going to be straight ahead negotiated result. So what I would do is I would, if I'm the startup, I would think about what do I think is a reasonable price round valuation, and then I would set my valuation cap above that. So if a reasonable price round valuation is 3 million and a stretch valuation is 5 million, I would set my valuation cap at 5 million. So or maybe even 6 million. Let's say I want to do 5 million valuation cap. I would probably start negotiation with a valuation cap above that, assuming investors might want to negotiate the valuation cap down. So this is going to be, there's I don't think there's any way to calculate valuation cap like using any of the methods that we described, because that's supposed to calculate your actual valuation, not the valuation cap. So I think if you calculate your actual valuation and then set your valuation cap above that, then that'll give you a good negotiating position. Okay, and then next question, why the required return was 21? I answered that already. That was given in the case. Could you go back to the slide for the answer to assignment 4? Yeah, we did that. Okay, next question. Not all VCs are fair. What are the top 5 red flags in negotiation with VCs? So this, I totally agree. Not all VCs are fair. Red flags for negotiation in VCs. There's like a lot of potential red flags. I mentioned red flags in some previous class. Like, for example, any VCs are asking for any non-standard terms, meaning there's some term that the VC puts into the agreement that's not a standard term, meaning you don't see it in agreements. For me, that's a red flag. Or the VC puts in a standard term with a non-standard parameter, meaning the term, let's say, for example, let's say non-standard term for me would be the VC puts a term in that says they're never diluted, no matter what. That's a non-standard term. That should never be in a shareholder agreement. So a VC that's asking for that, I would say, terrible red flag, let's walk away. Okay, but how about a VC that puts in a liquidation preference? It's a standard term, but they want 5x. Again, that's a standard term with a highly non-standard parameter. Again, that's a huge red flag for me. I would walk away. A VC is asking for a personal guarantee by founders. Walk away. A VC is asking for more than 30% equity. Walk away. VC is asking for a controlling stake in the company. Walk away. So I think that's more than 5 red flags. The VC says something that is inconsistent with your vision for the company. I think that's another terrible red flag. Walk away. The VC says something you don't believe or something not trustworthy. Red flag. Walk away. So I always say it's much better to not do the deal than do the wrong deal. Next question. What is retention percentage? So retention percentage means how much equity will the VC retain by exit. So retention percentage is sort of the inverse of dilution. So if the investor, assuming the investor begins with 100% of their equity, meaning like they got 20%, so 20% is 100. Let's say they were diluted by 40%, their retention percentage would be 60% because they would have 60% at the end of the exit or the end of the period that the model is looking at. So retention percentage, the other way you can think about it is it's the amount of equity that they started with minus their dilution. Could you explain more why required return is 21 for exercise 4? So there's no reason that 21 is the required return for exercise 4. That's just given in the case. It's just a number in the case. So don't read anything into that. It's just like, Johnny bought 6 apples and then he ate 2. How many does he have left? Now he has 4 left. Why did he buy 6 apples? He bought 6 apples because that's the number in the case. So there's nothing to read into that number. We're not saying 21 is the real number or the right number in that case. For a particular company, it's just an example in that case. Okay, when using comparables method with public companies, is enterprise value over EBITDA or enterprise value over sales better for valuing enterprise value, and which multiple should we apply to startup valuation? So this for public companies, my business is not valuing public companies, so I'm not going to comment on that. But I don't have a view on what's better for valuing public companies. But for applying to startup valuation, so whether to use a earnings-based multiple or a revenue-based multiple for your startup depends on your exit strategy. So if your exit strategy, for example, is trade sale, and in your sector, startups that are purchased in trade sales are typically priced on revenue multiples, then revenue multiple is the right one to use. If you're planning an IPO and in the market where you're IPOing, companies are typically valued on earnings multiples, then you should use earnings multiple for your valuation. So the answer is it depends on the exit strategy. However, the startup is most likely to be valued at exit should be the multiple that you use for valuing your startup today. Okay, so next question. How do investors practically fill the gap of information asymmetry? Yeah, this is a great question because there is a huge amount of information asymmetry in venture capital investment. We are investing in companies that are private companies. Often they have little or no operating history. They may or may not have financial accounts and historical results. So there's always information asymmetry between investors and current owners and shareholders. But for startups, it's even worse. So how do we deal with that? The main ways that we deal with that are through deal sourcing through networks. So usually we're investing in companies that either we know the founders or somebody that we know knows the founders. So there's one way to address potential asymmetry. And the other way that's very much deeper is through the deal terms. So if you look at the shareholder agreements and investment agreements between VCs and startups, many of the terms in the agreements are designed to address the information asymmetry between the investor and the entrepreneur. So especially a lot of the control terms. So when this class, we don't deal with deal terms. We do other classes on deal terms. But if you want to delve into that more deeply, highly recommend understanding more about VC deal terms, and you're going to see how investors try to remedy those information asymmetries through the way that they structure their shareholding. Okay, so next question. Should a startup keep the list of potential investors anonymous to prevent them from ganging up to get themselves a better deal? So definitely it's not up to startups to introduce investors to one another if the investors don't already know each other. So if as a startup, if you have more than one interested investor, and if those investors are, if each of those investors are willing to do the whole deal themselves, or if those investors have their own co-investors who are willing to do the whole deal, there's absolutely no need for you to introduce those investors to one another, and you normally would keep that information confidential. So typically you don't go to one VC and tell them that there's interest from another VC unless the VC already knows. So oftentimes VCs will syndicate deals. So 2 VCs or 3 VCs will invest together in a deal, but that's typically the requirement of the VC to do, not the startup to do. So if you have more than one interested investor, I would definitely not reveal the identity of the one investor to the other. What you can do is you can tell each investor that you have another or other interested investors without saying who they are, because this can definitely, as I alluded to in a previous slide, this can definitely help your negotiating position. Okay, is Southeast Asia startup required to target sales for year 5 at 30 million USD as average? No, that's just an example. So definitely there's not one right revenue target for Southeast Asia or any startup to reach. But what I would say is if you're really want to be a startup and get a healthy size exit, I would target to reach 100 million US, which is 3 billion Thai baht in enterprise value within realistically 5 to 10 years. Now, and why do I say that? Because that's an average firm valuation for M&A transactions where larger companies buy venture-funded startups. So some valuations are much higher, some are lower, but most serious acquirers, they start looking at companies once they reach 100 million valuation. So what does that say for your sales? If the revenue multiple is 3x, then you should target 30 million valuation, so you get to 100. If revenue multiple is 5, then you could get there with 20 million. If revenue multiple is 10, then you can get there with 10 million. So I would think about, rather than have a strict revenue target, I would have, and remember, year 5 is just an average. So again, your actual year might differ, but I would think about, in my sector, my industry, given the revenue multiples that companies get priced at, how much revenue do I need to generate to get to 100 million, and do it that way? Okay, next question was, can we use the VC valuation method for SMEs? So I think I answered this question online also, but it's a really good question. And I would say, you could use the VC valuation method for SMEs if your SME is going to be acquired by a large company, or it's going to go to a listing. So because VC valuation method only requires that the company is going to be sold. Now the challenge here is that a lot of SMEs don't get acquired by large companies and don't go for listing because their trajectory is not toward an exit like that. They want to often continue to be owner-owned, run and operated without exiting. So if you're an SME that's planning an exit, then you could use VC method to value your company. The other thing to keep in mind is that VCs typically require very high growth in order to generate the required return. And Another characteristic of SMEs, maybe the most important distinguishing characteristic that separates SME and startup is the growth rate. So typically, SMEs are designed to grow more slowly over longer periods of time and generate profits earlier and more consistently than startups. And startups are designed to grow, especially top line, very quickly and increase firm value. So so I would think about how will that affect your pricing if you use VC methods to value your SME. Okay, next question is, can startups mention in term sheet that any investor cannot out before XX stage? Can startup mention in term sheet that any investor cannot out? I don't 100% understand that question, but let's say if I do understand, meaning investors are not able to sell out before a certain stage. This is highly unlikely that investors are going to accept this. Investors will usually require the right to sell their shares whenever they want. But the good news, good news from the entrepreneur perspective is typically these type of investments are highly illiquid. So it's usually not easy for investors to sell their shares before the exit. But if I understand this question correctly, and the idea is to limit investors' ability to sell their shares, I would say the vast majority of venture capital investors, at least, will not accept any limitation on their ability to sell their shares. Okay, so next question. VCs are frequently telling us that they make their decisions quickly, but it's not in their interest as longer discussion. Founders need capital more urgently. How to speed up the process besides having more than one option? Yeah, so you can tell I was going to say the way to speed up is to have more than one option, but actually that doesn't even help, because why? Even if you have more than one option, the more than one option is going to end when you ultimately sign a term sheet. You can only have more than one option until you sign the term sheet. And then once you sign the term sheet, vast majority of term sheets will have exclusivity clauses that restrict startups from talking to any other investors or engaging in any other negotiations for usually 30, 60, or 90 days. And so you can expect that pretty much every term sheet that you enter into is going to limit your ability to talk to other investors once the term sheet is signed. So you're still stuck back in. What happens when the investor drags the process? So one way to do that is with this exclusivity clause. So the exclusivity clause limits the startup from talking, but it also to other investors, but it also puts some timeline on the investor, because let's say you agree to a 60-day exclusivity clause. If the investor does not complete the transaction by 60 days, then the exclusivity expires, and now startups are free to talk to others. So one way to keep investors moving is to agree to shorter exclusivity periods. So maybe 30 or 45 days. You can try to push investors to shorter exclusivity periods. Now, this also has some limited effectiveness, because usually what happens, let's say we agree 45 days, and then on day 44, the deal's not done yet, and then the investor asks for an extension. And you can not give the extension, but let's say the investor says, either we get the extension or we're going to drop the deal. So now it's a tough call for the startup, because usually what happens, by day 45, we're really close. We just need another 2 weeks. So let's extend for 2 weeks. But then 2 weeks later, same thing. So once the startup gets into these serious negotiation with the investor, it can be hard to walk away. So I think the key there is you do want to get short exclusivity periods. Don't extend too many times, and be willing to walk away if you really feel that the investment's not going to happen. one other way that you can try to keep investors on schedule, it is possible to have to include a breakup fee in the investment deal. So you can try to put in some sort of penalty that the investor has to pay if they don't consummate the deal, or if they don't close the deal by a certain date. Now, a lot of investors are not going to agree to that. This usually works only when the startup is in a very strong position, and it also can be hard to enforce those clauses because the investor can always say that the startup caused the deal not to happen. But those are some of the things that you can try to do to get the deals closed as quickly as possible. But yeah, it's a real issue. A lot of these deals do drag on, and key thing is to know when it's not going to happen and walk away. Okay, can I go back to the very basic? Next question. Why does exit valuation calculated from only exit year earning multiple by earning revenue multiple? What is the meaning of the formula? So exit valuation, we're trying to figure out, okay, so basic, the exit valuation means if we're modeling that this company is going to be sold in year 5, how much will the company be sold for? So when we try to calculate that number, so what price is somebody going to be willing to pay for this company? How do we figure that out? There's usually 2 ways that buyers price companies. They price the company by multiplying their revenue by some number, or they price the company by multiplying their earnings by some number. So revenue means sales and earning means profit. And what's the number that they choose to multiply the revenue or the earnings by? This is called the earnings or revenue multiple. Where do those multiples come from? They come from averages for industry or for company type. So for example, maybe manufacturing company might be valued at twice their revenue, or even 1 or 2 times their revenue. Software company may be valued at 5 times their revenue. Software as a service company might be valued at 10 times their revenue. So where do these numbers come from? They come from industry average. So we look at how much for companies where we know how much people are paying for the company's shares, then we look at what multiple of the company's revenue and earnings do these prices calculate to. So that's where we get those multiples, and that's what those formulas mean. So what should be the entrepreneur's standpoint on dilution provision when negotiating deal terms with VCs? Should entrepreneurs accept anti-dilution? So, I mean, I can't advise every entrepreneur on what their standpoint should be or whether they should accept particular terms or not, because this will depend on the company and the specific deal terms. But generally, there are different formulas to calculate anti-dilution, and there are formulas that are more favorable for the company and formulas that are less favorable. So I think if my advice general advice, and I would have to see the specific situation to really make advice, but general advice would be, if you can get reasonable formula for anti-dilution, meaning a relatively company-friendly anti-dilution formula, and if you can trade the anti-dilution clause for other terms that you like or that are important to you, like for example, you get a much better valuation or a much better liquidation preference, I would be willing to accept the reasonable anti-dilution, because reasonable anti-dilution, any kind of anti-dilution, only hurts the company if the company has a down round. So in some way, you can give anti-dilution and get whatever you're getting for free if you never have a down round. So let's say, because then your anti-dilution is never triggered. So if you're confident that you can avoid a down round, then accepting anti-dilution in exchange for something that's valuable to you can be a pretty smart negotiating position. Okay, next question is, let's suppose that there is a Series A investment. Two investors are willing to invest together, but they come up with different valuation. So this should never happen, because if two investors are investing together, one investor should be leading that deal, and the investor who is leading the deal should set the valuation. That's almost the definition of lead investor, is the lead investor sets the valuation. So we should never find ourselves in a situation where two investors who are co-investing in the round have different valuations. If that happened, I would be very concerned from the company perspective that these two investors are not talking between themselves and agreeing to a valuation. So, we talked about investor red flags before. I think if you have an investor syndicate where for example, with two investors, like we're talking about here, and each one has a different valuation, I'm very nervous about these two investors. So I would want to really understand how that happened. And of course, if I'm the startup and there's two investors with different valuations, I want the higher valuation. As soon as one investor proposed a higher valuation, I would only be willing to accept that, not the lower valuation anymore. Okay, so next question. From your experience, what is the average value in USD that investors would invest in startups at seed stage, specifically in Southeast Asia market? So yeah, that's a great question. The average size of investment for seed stage in Southeast Asia, I see somewhere between, I would say, 200 to 500,000 US dollars is average seed stage. So some seed stage are smaller and some seed stage are bigger. Like you might see 150,000 seed stage, but by then you're starting to get into almost pre-seed. You might see, occasionally we'll see some 600,000 seed stage or 700,000, but I very rarely see seed stage investments above that. And for example, our average seed stage investment in our Thai fund is 300,000 US, 10 million Thai baht. And I think that's not unusual. So I would say somewhere between, let's say 2 to 5 is about average. Okay, next question. How much in terms of percentage do startup founders in Southeast Asia apply 1x participating liquidation preference? You mean, meaning what percentage will take 1x participating? I would say, I don't have that number, but I think about half of deals have some liquidation preference, about 50%. I strongly advise to do non-participating liquidation preference, and I would not do liquidation preference above 1x. I think anything above 1x is too high for liquidation preference, and I would try to avoid participating liquidation preference. I would be willing from the company side. I would be willing from the company side to accept 1x non-participating liquidation preference, especially if I can get a bump in valuation to do that. But I don't have the exact percentage on 1x participating in Southeast Asia. I will say I have seen specifically in Thailand, I see some liquidation preferences above 1x, which I think is not correct. I mean, from a company side, I would not accept that. Okay, next question is, I have two questions. If there is no peer company in the same region, how can I adjust the exit value and revenue multiple from other peer company in other countries? Is there any suitable method or formula in that case? And then the next question was, how does customer acquisition cost and customer lifetime value impact valuation? So yeah, I think if you can't find comparable companies in the same region, yeah, then you can look at, there's a couple of ways to do that. If let's say you can't find comparable company based on your product sector, your industry or product sector in your region, but then you might use comparable companies from the same region in different product sectors, because I think geographical differences in valuation probably are greater than sector differences. So that would be one way to do. If you need to pick, if you need to do companies from another geography, I wouldn't say there's one specific formula to do that, but you might look at things like the relative GDP or difference in other prices. But I would prefer to look at companies that are not directly comparable on the product side, but for example, maybe stage of development side in the same region. And then customer acquisition cost and customer lifetime value, I wouldn't say those necessarily directly feed into the valuation, but these are important metrics that investors are going to look at. So make sure you know those. You make sure you know your customer acquisition cost and lifetime value. And the more favorable those numbers are, the better investment the company is going to be, whether or not they directly, they'll affect your DCF valuation, but I wouldn't say they're directly, like an input into your valuation. So next question was, why are startups in Thailand low survival rate? Startups everywhere are low survival rate. I wouldn't. My experience is not that startups in Thailand are lower than elsewhere. So my data I use from the U.S. Because we have great data on startups in the U.S. There are very low survival rates of startups in the U.S. And I look only at venture-funded startups. So if you remember from earlier class, I looked at 75% of venture-funded startups in the U.S. either deliver zero, which means die, or deliver less than one time, which means almost die. So about 75% of startups in the U.S. don't survive or die. Actually, startups don't survive is nothing wrong with that. We expect a lot of startups to not succeed because doing a startup is very difficult. So, but at least my experience so far is that Southeast Asia in general and Thai specific startup success and failure rates are not measurably different from rates elsewhere. Now, we're also very early in the market in Thailand and Southeast Asia. So I think we're probably going to see, even improvements over time. So next question is, what if the valuation of DCF is over startup valuation, which I think that means over VC method valuation. But if you do your DCF valuation and it's more than you think it should be, then if you did the DCF valuation properly, then I would increase my valuation to match that. If your DCF is higher than your VC method valuation, then you might want to adjust some assumptions in your VC method. I mean, definitely as a startup, you should go with whatever valuation method. As a base valuation method, I would go with whatever gives me the higher valuation, assuming that I have made reasonable assumptions to get those numbers. Okay, and I'm going to have to end the questioning now because we have gone way over time, and I'm sure everybody has other things that they want to get to tonight. Since this is the last in our 4 module session on startup valuation, I want to again thank our partners, YBI, which is funded by Youth Business International, which is funded by Google.org, and Stock Exchange of Thailand, who have been our invaluable and supportive partners in this program to help entrepreneurs, especially young entrepreneurs, to recover from the terrible effects of the pandemic. And also SMEs and small business owners are included in our target for this program. It's been a great experience to work with you over the last 2 weeks on startup valuation. I know that we had to go quickly through a lot of material because I try to make sure that you understand everything that you need to know about startup valuation. There's no way you're going to learn everything that you need to learn about startup valuation in a few hours, but hopefully now everybody knows what they need to know. And I hope that this program has given you the roadmap to becoming much more comfortable and capable in valuing startup companies, and to look forward to seeing you again in the future. You will continue to have access to the companion online course for a while. We'll let you know when that access expire, but you can continue working there, work through the problems. You can keep all the financial model and the exercise you downloaded. And if you're interested, to learn more in depth about valuation, we also have much more detailed valuation courses that you're welcome to explore. Don't hesitate to reach out to talk about that. And I will also continue to answer questions in the companion online course, so please feel free to ask more questions there. And again, thank you participants for all of your attention and great questions. It's been a pleasure to work with you, and I hope we'll see effects of better valuation in our markets and happy startups and happy investors.